Henry Ford said, "If I had asked people what they wanted, they would have said faster horses." If Chris George, founder of CMG Home Loans, had asked people what they wanted from a mortgage, they would have said lower rates or possibly longer terms. But innovators don't optimize the old model. They replace it. Chris reimagined the mortgage. Instead of treating it as a fixed monthly obligation, he asked a better question. What if your mortgage could behave like a financial tool instead of a financial drain? That's how the all-in-one loan began. Let's start with what we're all used to. The 30-year term for a mortgage was authorized by Congress in 1954 to make payments feel affordable, not to make them efficient. It's a great loan to help people enter the realm of homeownership, where they can begin building house wealth. But let's be sure we look at how they actually work. Nearly all early payments go to interest. Thank goodness for appreciation, or the first several years would feel like renting. Here's the kicker. Most homeowners restart this cycle every 5 to 7 years through refinancing or selling. So the system quietly keeps people in the permanent early years where interest is highest. This chart shows just how expensive those first 10 years really are. On a $500,000 loan at 6%, $278,000 would have gone to interest. Even at 3%, $133,000 was an interest expense. And remember, that's in the first 10 years, assuming you're paying it as the account set up or the loan set up. No wonder the mortgage industry hasn't evolved in 70 years. This is extraordinarily profitable for banks. Chris George's question was simple. How do we reduce the drag of mortgage interest without requiring a higher payment or a lower rate? That's the problem the all-in-one loan was built to solve. Let's shift to the other half of the equation, checking accounts. They're the birthplace of net worth, as they help store income dollars once received. But they're also inefficient, as your income sits idle in a bank, earning fractions of a percent, while your mortgage charges multiples of that. And here's a staggering fact. Most homeowners run more money through their checking account in 5 years than they owe on their mortgage. But we've never had a way to make that money work while we hold it. When we look at cash flow, you buy groceries weekly, you pay your car monthly, perhaps insurance premiums quarterly and taxes annually. You always need the money eventually, which means it tends to sit, unused, unleveraged, unproductive. But what if those idle dollars could reduce your interest cost every single day without committing them permanently? CMG took these two financial dinosaurs, the checking account and the traditional mortgage, and combined them to create a game-changing financial product, the all-in-one loan. It's an offset mortgage, a home loan plus a full-featured deposit account, where your income automatically lowers your balance and your interest without restricting access to cash. Most homeowners give up control of their cash to get the illusion of stability. But real wealth builders reverse that flow. The all-in-one lets every incoming dollar work. Debt shrinks, liquidity remains, flexibility goes up, financial drag goes down. A mortgage is a function of 3 variables, and rate is just one of them. It's also time in debt and the amount borrowed. Rate is set by the market, purchase price drives the balance, but time in debt, that's the lever you control. Lower the balance faster, reduce time, slash total interest, drop your effective rate. The fact is, a 3% loan over 30 years costs $18 more per $100 borrowed than a 6% loan over 10 years. The lesson? Rate matters, but time is the multiplier. And with a different loan structure, compressing the timeline becomes realistic, not theoretical. CMG created the only mortgage where starting on day 1, your dollars work harder for you than for the bank because you're reducing principal first, not interest. The all-in-one is a home equity accelerator. With the all-in-one, every deposit immediately pushes your balance down, which reduces the interest accruing. Yet those deposited dollars remain fully accessible. No more idle dollars. Every penny is put to work and turns a static mortgage into a dynamic tool. It's not conventional. It's smart money for people who want to be in control. Here's the engine behind the system. Your deposits go into the bank, but instead of sitting there doing nothing, the deposited amount immediately sweeps over and lowers your mortgage balance. The interest amount recomputes each day, is totaled at the end of the month, and comes out of the account on the 21st of the following month. You spend as you need to, but any amount you don't need to spend is keeping your loan balance, and therefore your interest expense, down. Those idle dollars over time are lowering your loan balance and increasing your equity. Same income, same expenses, completely different outcome. This is where the all-in-one really becomes personal. It's a lifestyle product, and whether or not it makes sense for someone depends entirely on their finances. Fortunately, we have a robust forecasting tool for the all-in-one loan. We enter your scenario, your income amounts, how often money flows in, and your spending rhythm. If you want to go deep, we can break your expenses into weekly, monthly, quarterly, even irregular patterns. Then the system models how the all-in-one would perform for you based on your actual cash flow. This is an example of what those results look like. In this case, the couple cut their time in debt in half without changing their budget. 179 months instead of 360. And they saved $224,000 in interest because the system reallocated idle capital that's moving through their checking account. This is the power of using your cash flow with intention instead of letting it sit unproductive. I have multiple case study videos showing how this has worked for real people. It's always fun to run the numbers. There are cases it pays off in under 5 years. There are other cases where we see that this is definitely not the right loan for them, and I'm glad we have traditional financing to fall back to. Here's where the all-in-one separates itself entirely. Even after the loan is paid off, access to the line remains for the full 30-year term. In the previous example, at the point the all-in-one is paid off, there is still a principal balance of $342,000 on the traditional mortgage. Cash flow determines speed. And that's why I run each scenario through our forecasting platform, because the results are unique, but the mechanics are consistent. Let's take a closer look at how the line of credit side of the all-in-one works, because this is one of the most misunderstood and most powerful features. Since mortgage products are currently limited to a maximum 30-year term, the all-in-one must fully mature within that window. That means the credit line gradually reduces over time. You have access to the full line for the first 10 years. By year 20, you still have access to 50% available. So if your starting line's $500,000, you have access to all $500,000 through year 10. By year 20, you still have access to roughly $250,000. Now, a few important distinctions. Remember, a traditional mortgage locks away every dollar you've paid in. You cannot access a penny of that equity without refinancing or adding a separate HELOC. Also, with a traditional HELOC, 10 years is generally the max draw term, and it's often much shorter. At the end of the draw term, it turns into an amortizing loan, where you are once again locked away from the principal you've paid into it. No access, no flexibility, no optionality. The all-in-one is fundamentally different. You retain long-term access to some portion of that credit line for decades. Now let's look at what this enables in real life. In this example, the couple was powering down their balance when their kid went off to college. They simply wrote a check for tuition. Later, they wanted to buy an investment property. They didn't apply for a new loan. They didn't need a credit check. They became a cash buyer because they could literally write a check from the available credit line. Need to buy a car? When the equity is available, you can write a check. Unexpected expense? Write a check. I get it. I'm aging myself by saying write a check, but however you choose to pay for things, the point is the same. When the line is available, you have frictionless access to capital. This is long-term liquidity married to long-term debt reduction, something the traditional system simply can't replicate. What does the all-in-one accomplish? Faster payoff, 2 to 4 times sooner, massive interest reduction, continual access to liquidity, no dependent on rate drops, no need to refinance once in place, all without changing your budget. Bonus, because the all-in-one puts your idle dollars to work every single day, The old struggle of should I prepay my mortgage or invest disappears. You're no longer forced into that either or thinking. This structure lets you build long-term wealth and accelerate payoff at the same time. It's no longer about choosing between long-term growth or short-term relief. It's about aligning both with a smarter strategy that uses the natural rhythm of your cash flow to your advantage. I'll close with this Japanese proverb. The longer you stay on the wrong train, the more expensive it is to get home. The same is true with a traditional mortgage. Staying too long in the wrong structure quietly siphons away opportunity. The important thing is to make decisions based on the numbers that are unique to you. That's why the next step is simply seeing what this would look like for you. Reach out and let's run your scenario through the all-in-one forecasting simulator. You'll see exactly how your cash flow interacts with the structure, how quickly your balance could fall, how much interest you could avoid, and how much liquidity you retain along the way. No commitments, just a clear model of how the math plays out for you. If you're even a little curious about what's possible, reach out. Let's plug in your numbers and see whether this structure accelerates your goals. The results tend to speak for themselves.